Chapter 3: The Double Entry System. The double entry bookkeeping is a system by which transactions are entered twice in two accounts, one on the debit side and one on the credit side, so that the totals of each side of the accounting equation should still be the same. Accounts contains details of transactions related to a particular asset, liability, or capital. In the double entry system, the debit is the left-hand side of the accounts, while credit is the right-hand side.
A T account is a place where bookkeeping entries are laid out in a T shape, where a title should appear on every T account. Let's break down a simple business purchase. You decide to start a small bookstore. You use $20,000 from your cash to buy books to sell. This is how you write it down. In the records, you make two notes. First, you add the value of the new books you got. This is called a debit. Then, you subtract the cash you spent. This is called a credit. One by two notes. They always cancel each other out. This is the main rule of keeping books. Every time you add something, you must subtract something else of the same value. This simple rule makes sure your money records are always right and nothing is missing. Let's talk about double entry records. There are 4 steps for recording a financial transaction. First, we need to identify the accounts that are affected by the transaction. This usually involves at least 2 accounts. For example, if a company makes a sale, it affects both the cash account and the sales revenue account. Next, we will classify these accounts into one of 3 categories: assets, liabilities, or capital. Understanding which category each account belongs to helps us determine how the transaction impacts the company's overall financial health. Now, determine which accounts should be debited and which should be credited. Debits increase assets and expense, while credits increase liabilities, equity, and revenue. This step is vital for maintaining the accounts equation. Finally, we'll enter the date, details, and the amounts for each account involved in a transaction. This ensures that our records are not only accurate but also organized and easy to follow. By following these 4 steps, we can maintain clarity and precision in our financial records, which is essential for informed decision making.
Next, we'll cover the accounting equation. Simply put, this equation is the absolute foundation of the entire accounting cycle. It shows us how every single business transaction affects a company's financial position. There's a key point to remember. The business and its owner are treated as completely separate entities. Therefore, the resources owned by the business must equal the resources supplied to it. This brings us to the formula itself. Assets equal capital plus liabilities. Assets are the resources.
This is an example of the accounting equation. Mrs. Lee has just started her business with assets like van, cash, and machinery. She invested her own capital and took a bank loan. According to the basic accounting equation, asset equals to capital plus liabilities. This shows how assets are financed through owners' inequalities and liabilities. Next, we talk about the extended accounting equation, which is shown above. Revenue is income earned, expense are costs incurred, and drawings are owner's withdrawal for personal use. All these affects the owner's inequality over time, which is the increase in revenues means an increase in capital, while the increase in expense or drawings means the decrease in capital. Understanding these components help us see how daily business activities impact the financial position. This is the end of the presentation. Thank you for your listening.